Hi folks, welcome to this short lecture to introduce you to the topic of Treasury shares. In a previous course, we talked about share retirement, and when a company decides to retire some of its own shares, it removes them from their books at their average cost, and it pays cash to do so. So it's like buying them back from the investors. But what we've seen to date with share retirement is that when the shares are removed from the books, they are canceled, never to be reissued again. Well, there's another type of share out there, shares that are perhaps bought back by a company, removed from their books, but instead of canceling them, they may issue them at a later date. These are called Treasury shares. We refer to them here in the title. So a company that buys back their own shares and holds them for eventual resale, those shares are called Treasury shares. So when I say eventual resale, they're thinking of reissuing them. When we repurchase the shares, we hold them in a special account known as Treasury shares. And Treasury shares, that account, when you're buying back shares and putting them into that Treasury share account, that you debit the Treasury share account. So the Treasury share account has a debit balance. So I'll just add it here. And that's its normal balance. Okay, so Treasury share account does have a normal debit balance. Now, not all provinces are allowed to hold Treasury shares. In Ontario specifically, we don't. But in some countries, in a couple of provinces, and in particular in the U.S., they are allowed to hold Treasury shares. So we do need to know some of the accounting for them, not just what the entry looks like when we buy back shares and hold them in Treasury, but when we reissue them, what does the entry look like? So we have a straightforward example here just to introduce you to the topic. When the Treasury shares are held, again, they're reacquired, and as we said, the account they're held in, the Treasury share account, has a debit balance, but they can be reissued, and when they're bought back and held in Treasury and reissued, they're tracked. The cash price that we pay to reacquire the Treasury shares is debited to the Treasury share account. So that's what we said before. When you buy them back, we debit the Treasury share account. You can see in the following example how it works. So let's say we're a company, and we sell 10,000 common shares at $28 a share. What we're used to doing is debiting cash and crediting common shares for what we've paid for the shares. Let's assume that now of those 10,000 shares, we decide to buy back 3,000 of them, and we're going to hold them in Treasury. Again, we said that we're going to track the Treasury shares by debiting them, not to common shares, although these Treasury shares are a subset of the common share account. So in other words, these 3,000 shares are part of the 10,000. We don't debit the common shares. We want to make sure that we track the activity in the Treasury share account. So by doing so, or to do so, what we do is we debit the Treasury share account for common by 3,000 times what it cost us to buy them back from the investors, which is $30 a share. So we're going to debit the Treasury shares and specify that we're creating Treasury shares as a result of, because the Treasury shares are a subset of the common shares, 90,000, and credit cash, which is what we paid for these 3,000 shares, and at $30 a share, 90,000. Now, let's say of these 3,000 shares that we're holding in Treasury, we want to reissue some of them and give them back to shareholders. What would we do? Well, the entry is going to depend on whether or not we're reissuing the Treasury shares at a price higher than what we bought them back at or less. In this case, if we're paying more than what we paid to buy them back, then we're going to have to credit two accounts. The Treasury share account at cost being the $30 at which we paid to buy them back in the first place. And then we're going to have to debit cash because we're getting cash, okay, from people, the investors. But we also have to credit another account, contributed capital on Treasury shares. You were introduced to contributed capital previously when we talked about share retirement. So now we're just coming back to reintroduce you to that concept of Treasury capital, but only with respect to Treasury shares. So we'll have to credit that as well. So how will the entry look? Well, let's say we create this situation. So we're going to buy back the shares, in our case, at a price higher than their cost, which is $32 a share. We're going to take in the cash from our investors. Don't forget, we've only decided to buy back or to reissue 750 of the 3,000 shares. So we're going to buy them back from the investors. 750 times $32 a share, which is $24,000. And for that $24,000, we are going to reissue those treasury shares, right? Put them back out in the market, but we're taking them out of the treasury account based on the price we put them in at, which is $30 a share. The difference between the two is going to be contributed capital on treasury shares, $1,500. So we calculate the $1,500 by plugging it. Okay? Now, let's say the treasury shares are not issued at a price that exceeds their cost. Let's say we reissue the treasury shares at a price lower than their cost. So if you pay less, if you reissued them, if you reissued those treasury shares at a price lower than their cost, then you're going to be a little light on the debit side. Why? In the case where you're reissuing treasury shares at a price that's lower than their cost, what's going to happen is that you're going to get less money from the investors than it cost you to initially buy them back from investors at $30 a share and hold them in treasury. So therefore, you're going to have to shore up the entry to balance on the debit side. So what you'd have to do is debit any existing contributed capital on the treasury shares, but only to the extent it exists. So contributed capital for treasury shares works the same as any other contributed capital we've talked about. Okay, when you are, in this case, buying, reissuing the shares, if there's any contributed capital that exists from previous transactions, you're going to debit it, but only to the extent it exists. So you can only debit it to the extent that you have it. If you don't have any, then you're going to have to debit retained earnings. Or if you don't have enough, you're going to have to debit retained earnings. So this is what we discussed here. So now let's create a little scenario to show this. So let's say now we reissued 850 of the original 3,000 treasury shares at $24 a share. So the investors are now giving us $24 a share when we reissue them to the investors. But don't forget, we paid $30 to buy them back. So we're going to take in the cash on the $850 that we're reissuing to the investors at $20,400. We are going to credit the treasury shares, so we're going to reissue the shares, but don't forget, it's at the cost that we bought them at, which is $30 when we bought them back and held them in treasury. So we're issuing them at that same price. We're going to now, we see that $20,400 and $25,500 doesn't balance. So to shore it up on the debit side, what do we need to do? Well, you notice from the previous transaction, we did have some contributed capital from treasury shares, and we said here that we're going to debit any contributed capital to try and balance the entry. So we don't have enough, but we can use what we have, which is $1,500. So we're still $3,600 short, so that difference would be debited to retained earnings. Now, if we had to do a financial statement presentation in the equity section to date, remember that any treasury shares that are held with us are treated as having a debit balance. So most equity accounts, common shares, preferred shares, retained earnings, their normal balance is credit. But for treasury shares, their normal balance is debit. So we refer to it as a contra equity or a debit balance account. And we show it in the equity section of the balance sheet at the end by deducting the shares that we have at their cost, what it cost us to buy them. So now if we look at the entire equity section, what would it look like? Well, remember, this whole thing started because we had treasury or common shares that we bought for $280,000, and we bought 10,000 of them. So what we have to do here is to show the common shares, the original 10,000 that we issued, but don't forget, we've only got 8,600 outstanding. Why 8,600? Because 1,400 are with us. So we've got, in essence, 10,000 shares issued. 1,400 of those shares are with us in treasury, because don't forget, we bought back 3,000 of those 10,000 shares. we still hold 1,400 of them. How do I know? Because we reissued 1,600 of them to shareholders. So of that 10,000, 1,400 are still being held by us, because you need to treat these 3,000 that you originally bought back and held in Treasury as a subset of these 10,000. So they're included in it, right? So all we're doing here is we're saying, well, we never debited or credited after the common shares were issued in the first entry. So after this entry up here, we never touched the common share account. Why? Because we got to track the Treasury shares, right? So instead of debiting or crediting common shares directly, when we had Treasury shares, we debited and credited Treasury share accounts specifically. So what we're going to do is we're going to leave the balance of the common shares intact, because after we issued those common shares for $280,000, we never touched it, right? We're going to keep that balance as is, acknowledge the fact that 8,600 shares are out there with legitimate shareholders. We cannot hold shares in our own company, right? So the idea is that we have to earmark them as Treasury shares, and that's the 1,400 of the 3,000 that we didn't reissue yet. So we keep the 280 as is. On the very bottom of the equity section, we will deduct the 1,400 shares that we have at their cost of $30 a share, which is $42,000, because again, it's got a debit balance. To show a debit balance, we have to bracket it, okay, and we have to deduct it, because it's a subset or a part of those common shares that we're holding, right, that haven't been reissued. So we deduct it, okay. Now, we've got a retained earnings account. I created it here just to show you how retained earnings balance would be calculated. If it had $55,000 and we debited it here to record our Treasury share transaction when we reissued those shares, okay, we're going to deduct that $3,600 to get $51,400, and we don't have now any more contributed capital in the Treasury share account, because you remember in this transaction we debited for $1,500 and we only had $1,500 that we put in it in the first place. So therefore it's got a zero balance. So our total balance here in our shareholders equity account, or shareholders equity section of the balance sheet, would be $289,400. So notice again that the actual common share account remains untouched. We track the Treasury shares separately so that we can determine if any unethical trading can take place, because what happens is that a company could buy back their shares and then time the reissuance to create, which allows them to create a demand for their shares. So they could pull shares off the market, and if people want to buy them, if they're limited in the number of shares that are out there, then people might bid up the price for the shares, and then the company can reissue them at a time when they would get more money for them. That's called price fixing in your shares, and you can't do that. So therefore, we don't touch the common share account, and for that reason, to monitor the Treasury share activity, we keep it in a separate account. The other thing I wanted to say is that dividends are actually paid only on Treasury shares that have been reissued. So we would pay a dividend on those 1,600 shares that we reissued, right? But the 1,400 that are being held in Treasury, we do not pay dividends on them. They're not eligible for dividends. But the 1,600 again that we reissued, we would pay dividends on them. Okay, now in your course, you'll find other videos on Treasury shares, and I would advise you to look at them because they all present different scenarios for you that you need to consider. All right, so I hope you enjoyed the video, and enjoy your day.